market update brought to you by REAL ECN. This week, FX update will encompass the Euro-dollar market. A correction in the equity market over last Friday trading session translated to further weaknesses in the Euro-dollar pair, as investors are closely monitoring whether this spike in the VIX can potentially develop into a full-scale risk aversion. Technical indicators on the single currency continue to support the bearish bias. However, a shift in retail trader sentiment on the pair is hinting in near-term corrective rebounds. This commentary will be broken down to the two components. The first component that we would explore is the technical front of the Euro-dollar market. Last week's Euro brief rally failed to sustain its bullish momentum as a correction in the equity market forces the single currency to give up all of its intraday gain as the pair retraces back to the 1.2600 level. Currently, the pair is trading slightly above the 14.6% Fibonacci expansion marked by the 1.26151 level. Failure to sustain trading momentum above this level would expose the pair to the next support tier at 23.6% expansion marked by the 1.25071. Based on the weakening euro fundamentals, analysts look forward to future selling opportunities. However, since the pair is trading close to its support tier, the risk and reward profile of the short trade at this entry point does not justify. In accordance to the SSI, which is commonly known as the Speculative Sentiment Index, there has been a shift in retail traders' position towards the euro-dollar pair. Currently, retail open long and short positions are locked in a conversion trapped as short interest is gaining traction. If this short interest picks up, the single currency may possibly be overdue for another corrective bounce. Since the euro dramatic decline began 3 months ago down 1,000 pips, this is the first time that retail traders on short interest matches that of long interest. Analysis of a collection of technical indicators on the hourly time interval on the euro-dollar cross is suggestive of a temporary bearish market sentiment and recommends sell positions on the euro. The euro-dollar cross opened today's Sunday trading session inching closer to the established Fibonacci resistance at 1.2636, while the Fibonacci support is set up at 1.2594. Since the euro-dollar correction to the downside during Friday's trading session, the pair broke below the 200-day simple moving average during the end of last week's trading session. Therefore, this is very indicative of a long-term bearish outlook on the cross moving forward, if it cannot hold above the 200 days. This bearish standpoint is also validated on the short-term moving average front as the pair opened today's trading session above the 5 but below the 10 and 20 days simple moving average, which is indicative of a sell recommendation on the short-term moving average front. Moving along to the fundamental component of the euro-dollar market, a spike in the equity VIX materializing over the last few trading sessions can potentially mark the beginning of a shift in risk sentiment towards risk-averted theme. However, it is also noteworthy to understand that quite often a spike in market volatility often fails to provide a substantial follow-through momentum. Thus, monitoring the development of the momentum in market volatility over this week's trading session is very important. The correction between the euro-dollar market and the VIX cannot be understated. Its negative correlative relationship often set the tone for opportunist traders to buy the dip. In this case, the lack of strong fundamentals supporting a full-scale risk aversion would often revert the market price action back to its short-term view and weekly risk events. The second factor that has been driving the euro-dollar market down is the expectation that the market has been pricing in is that the ECB will implement the second round of stimulus program. As the expectation of yield in the Eurozone drop amidst the talk of stimulus program, this may risk capital inflow that had been coming to the Eurozone after the financial crisis. A perceived narrowing in yield differential between the peripheral European bonds may trigger a rush in capital outflow, thus jeopardizing the euro-dollar exchange rate. There are several Tier 1, Tier 2 leading economic indicators coming out from the Eurozone this week. For instance, on Tuesday, investors can expect the release of the German ZEW current condition forecast to read at 18, while the German ZE economic sentiment is forecast to roll in at 1.0. In addition to that, the Eurozone industrial production is expected to contract by 0.1%. On Thursday, the market can expect the release of the Eurozone CPI year-on-year forecast to expand by 0.3%. Over in the United States, many analysts are beginning to believe that the bullish rally in the dollar may have been overstretched as the greenback had an amazing bullish run over the past 12 weeks. This rally was largely due to a build-up in the Fed's interest rate hike expectation and the slowing in the pace of the Fed's balance sheet expansion compared to the ECB's. Since 2011 and 2010 financial crisis, a full-scale risk aversion fear has become complacent. Last week's Fed minutes release indicated the Fed continued to remain adamant on the continuity of its status quo policy doctrine. Nevertheless, there are numerous risk events coming out from the US this week. For instance, on Wednesday, the market can expect the release of the US core retail sale month-on-month for September to expand by 0.3%, while the US PPI month-on-month is expected to grow by 0.1%. In addition to that, the US retail sale month-on-month is forecast to contract by 0.1%. On Thursday, the market can expect the release of the US industrial production month-on-month forecast to roll in at 0.4%, while the US Philadelphia Fed Manufacturing Index is forecast to come in at 19.9. Wrapping up this week's trading session is Friday. US building permit for September expected to roll in at 1.03 million, while the Michigan consumer sentiment is forecast to come in at 84.3. I want to thank all our listeners for spending their time with us and have a successful trading session, everybody.